world of index funds and ETFs, why should investor choose an actively managed large cap fund like JM Large Cap Fund?
As the name suggests, an index fund and ETF invest in all the constituents of a benchmark, while an actively managed large cap fund will typically invest in structurally strong companies and will avoid weaker companies. Secondly, an actively managed large cap fund can do sector rotation very swiftly and can benefit meaningfully wherever there are meaningful flows in the sector. Thirdly, and most importantly, an actively managed large cap fund can increase allocation towards the non-constituents of large cap, which is small and mid caps up to 20%, which can generate alpha for themselves.
How do you differentiate yourself in a segment as well researched as the large cap space?
So the secret sauce of managing a large cap fund is sector allocation, where one can go meaningfully underweight or overweight versus the benchmark. We actively manage our portfolio with a concentrated position of about 40 to 50 stocks. And at times when our investment theses are not playing out, we don't shy away from cutting losses.
How has the portfolio evolved over the last 6 months in terms of sector composition?
As we are aware, there are significant geopolitical concerns that are plaguing the market currently, and hence our portfolio has become a bit more defensive. We've increased our allocation to sectors such as utilities, while we've reduced the allocation towards IT sector. We continue to increase the allocation towards pharmaceutical sector, which are more defensive by nature and are benefiting from currency depreciation.
How do you manage the risk of a single large stock position having a major negative event?
So though we run a concentrated portfolio, we ensure that the average weight of stocks in our portfolio is between 2 to 3%, with no meaningful position above 5%, maybe save and accept 1 to 2 stocks. We ensure that our portfolio is reasonably liquid, and within a sector, we spread our risk across few names so that our portfolio doesn't get swayed by single stock volatility.
Can you throw some light on the exit approach followed in the portfolio?
Our portfolio follows the core and the satellite structure. Our core positions are positions which we keep for a longer duration of time, and we trim them when we think that the investment thesis has played out, or we think that the stock could go sideways for some time. On the satellite position, satellite positions are held for generating meaningful alpha in the fund, and typically when the investment thesis is not playing out or when the valuations are full, we exit our satellite positions.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.